All right, welcome everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 8th of August. Today, I was going to go over an email, and this is going to be more for people who have had an education in the stock market. I'm going to make this a little bit bigger. And here we go. Kevin, you're seeing this email because I need your help. What a rough year, and I'm giving up. I just can't do it, and my account is down big. This is, I didn't realize that was there. This is bull stuff. I'm just going to put it like that. And I would like to ask for your honest assessment of what I'm doing wrong. If it is possible, without naming names, would you review my portfolio and teach me what I should be doing? I would also like an overview of investing the Hurley Investments way. I'll be attending next Monday, and I am heartbroken for the accident for your family's gone through with your son. God bless you and your son. Best wishes and blessings on you and your son and family. So here we go. I found it interesting that that obviously this is what someone that's here today has typed in for me, and let me just start off this way. First of all, we're measured against the S&P 500, and my first question to the group is going to be why? Why are we up against or measured against the S&P 500? And there are no right or wrong answers. And I love that one to start off with, because it is a tangible reference point. I could buy that one. It's something that if I can go ahead and add a little bit more, it's something that represents, get an S there, the stock market as a whole. We had, because that's a standard and a tech and tech orientated, it's actually linked more to finance. The biggest sector is like finance, then energy, and then I believe tech comes third in the S&P 500. Now the NASDAQ would be a little bit different there. I like that one too, Mary. It's a measuring stick. I agree with all that. So it's just a point of reference, right? That's where we're going to go for right now. I'm going to put in here, without naming names, down big is 63% on a 6-figure portfolio. All right. So past history. I've traded everything. And I'm going to let you guys go ahead and start to fire off. If there's something you think I haven't traded, type it in here to ask me. I've traded penny stocks. I've day traded. I've stock picked. I've option traded. I've done futures. I've done futures, Forex, commodities, futures for commodities. I think I know what's coming here. Italian, not specifically, but I have done the pound versus the euro versus the dollar. So I've done something like that. I've spread traded. I've, what is it called? I've done the diversification. I've done long short. I've done equity swaps. I've done the newsletters. What is something else in here that I haven't mentioned? Good point. I've done adjusting trades. Anything else? Is there anything you think that is there? You know what? That's kind of funny. I've done commodities. I should do bonds, bond funds, REITs, treasuries, which is really bonds. So Bitcoin, believe it or not, I've dumped 5K in 50 different coins, NFTs, garbage, just to see what's out there. Russ, I'm not saying that. So I've done like Litecoin. I haven't done Bitcoin, but I've done Litecoin, all through CoinSmart. And yes, my 5K is sitting right around 2,300. It has not been profitable. In real life, I can tell you 50K can go to 255 and back down to 50K. I'm pretty sure that was 93 to 96. I can tell you 15K, actually, be honest, 20K can go to 85K and back down to 15K, but I took about 5K out. Those are the 2000s. And so I know I met some of you in education, and a lot of you have asked me, Kevin, why don't you spread trade more, right? I don't spread trade for a couple things, and they're kind of in that order. Lost and done, which is why a portfolio is down 63% year to date. You are over leveraged. Your portfolio was straight long when you probably shouldn't have any more than maybe up to 10 to 15% of your portfolio and leap long positions or stock related, stock replacement. So I'll go ahead and tell you 15% max should be a portfolio and stock replacement strategies. Even though we've just come off of the biggest bull run in stock market history, which is really 2008 till 2020. I wouldn't have up to maybe 20% in spread trades, right? It's speculative. This is speculative trading with options trading. That's why it's so dangerous. It's also speculative because not all adjustments work. Biggest problem that I have, it pisses me off. I hate losing money. When I say hate, I hate losing money. It pisses me off. I am not a nice person if I'm in all these option spreads and cool strategies and jelly rolls and blah, 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 blah. You've got to be smart in where you're at. So, if your portfolio is down 63% year to date, it's because of these two reasons. It's lost and done. You over leveraged yourself into option stock replacement strategies, when in all honesty, again, I said 2008, it's really like 2010 to 2020. That was our longest, most profitable bull run market. We had our 20% correction. That would technically end, unless you're a Democrat, it would end our bull run market. If you're a Democrat, we're not in recession, the bull run market's still running, all is good, and inflation isn't that big of a deal. Sorry, that was kind of a rude thing to say. 20% of your portfolio should be in spread trades. It shouldn't be any more than that. And the reality is, there's none out of all of these that I just listed for you. Penny stocks, day trading, stock picking, option trading, futures, forex, commodities, features for commodities, spread trading, diversification, long, short, equity swaps, newsletter, adjusting, treasuries, REITs, bond funds, Bitcoins, NFTs, all that garbage. There is no form of trading with a competitive advantage for the investor. And I can even come up here just to give you a heads up. Artificial intelligence. It's artificial because it's not real. All it's doing is gathering past information and speculating about the future. Gathering all your technicals don't tell you what a stock's going to do the next day. Algorithms. Again, there is not a formula, a mathematical formula that predicts the futures. The future, the movement of people's decisions, wars, it is not available to be helpful for you. And the funny one, yes, I have spent money on technical analysis, red/green arrows. It's crap. I mean, in 2008, they shut most of those dummies down. Anyone could read it. There was nothing proprietary about what these a-holes were doing. It was just, hey, who could I show something shiny to and move them into being helpful? So, for me, there's no other form of trading competitive advantage for the investor except collar trading or protective put. Now, with one more thing, there is also no average rate of return to count on, even though we have been doubling portfolios every 4.5 to 5.5 years. Unfortunately, there's no average rate of return to just be like, oh, I'm going to get this every year. I'm going to 20%, 20%, 20%. That's garbage. But this does protect your portfolio from being down 63%, is what I'm going to tell you. It takes the guessing out of having to trade. But there is no rate of return that you count on every single time. So Hurley Investments collar trades with these assumptions. Averages are not your friends. Anything made up on the way down is profit on the way back up. Taking a profit even when you could have made more is not a bad thing. We have the opportunity at times to dollar cost average without having to invest more money. We understand that truly no one knows where the market is going to go in the short term, meaning 1 year, 3 years, 5 years, or 10 years. And probably most important, weekly, we touch base with clientele to let them know what we are doing. And that's the key. I can't name you by name, but it comes down to you are way over leveraged in stock replacement strategies that you're toast. Your strike prices are too high. They probably will not come back in the year. There are times we just get it wrong. And your bull market ended March of 2020 when we pulled back as kind of a stealth 20% return to the downside. That was truly, by definition, the end of the bull market. So to think we were in a bull market the last 2 years is also not correct. The smartest thing to do would go back to, if you keep wanting to do it, it would be going back to spread trading. Spread trading and taking your singles, your smaller returns, or setting up your portfolio correctly. Stock ownership allows you forever to have the stock come back. If you're in undervalued stocks, you usually don't have to wait for forever. It'll come back quicker than that, but get yourself into stocks. Stocks move dollar for dollar. You'll get a dollar for dollar return. We have some really low price stocks that are out there right now. If you were to ask me, hey, are some stocks at a bargain? Yes, some stocks are definitely at a bargain and definitely at a price point that that I think is fabulous. And if I was to go through just in general, Apple's not at a bargain, but it's going up. Boeing is at a bargain. Bank of America's at a bargain. Baidu's at a bargain. Carnival Cruise Lines is at a bargain. Clorox is not. Costco is not. Salesforce is. CVS is not. Chevron is not. Discover Financial Services is. Dollar General is not. Disney is. Ford is. Freeport-McMoRan is. First Solar is not. General Electric is not. General Motors is not. Google L is not. JP Morgan is at a discount. KeyCorp is at a discount. Coke is not. Eli Lilly is not. Lockheed Martin is not. MasterCard is not. Meta Platforms is. Marathon Oil is. Marvel Technologies is. Microsoft is not. Micron is at a discount. Newmont Mines is at a discount. Netflix is at a discount. Nvidia is at a discount. PayPal is not at a discount. Starbucks is at a discount. Square is at a discount. Target is not at a discount. Tesla you should not invest in. Under Armour is at a discount. US Bank Corp is at a discount. Visa is at a discount. Verizon's at a discount. ExxonMobil is at a discount. Zions Bank is a discount. And Zoom Video you should not be investing in. So here I'm just going through a general list of stocks just because I know them and I know where we're at. It's an idea of where you should be looking at and where you can mathematically run some of your numbers to justify if a stock is cheap or it's not. So two of you just typed in small books. Perhaps we need to consider more on external forces than the market. Currently have world tensions, what appears to be overreach and a misuse of the government agency companies taking positions on China, which never occurred probably 25 years ago, and no value considered for the principles the nation was founded on, and no strong leadership for America. But private and personal interests seem to override the country's interests. Might be time to tie a knot at the end of the rope and hold on. Very interesting comments. The other comment that's, again, quite a bit here. Kevin, I agree that algorithms and artificial intelligence cannot predict future events, but we can learn from past history. Our past history right now says that we have a horrific administration that doesn't seem to know if he's in dementia, denial, or if he's even running our country. Some of our current administration principles are not founded on what America was founded on. Capitalism is still the best way to go. But okay, hold on though. For really quickly before I keep going here, I understand their political issues, but there have always been political issues, and it's always affected our market. Something to understand is we are becoming a more global market where it's no longer run by the US or by China. Europe hiccups and stock markets go down. Oil has a hiccup, stock markets go down. I mean, Ukraine is not even what, 2.3% of all of Europe's GDP. Mathematically, it's a human rights atrocity, but it has zero to no bearing on our stock markets. It really hasn't. This garbage of, oh, they've got so much wheat and so much of this and so much of that. The United States exports more of it. It should make us richer. It should be helping our futures and our commodities. Well, commodities is a global. Okay, there's no food shortages yet. And to say that there will be 3 years because such and such place was bombed and they're not going to be planting there in the next 5 to 10 years, I call bull hockey. So instead of going down hey, I'm a Republican, I don't like the Democrats, hey, there's political tension. There's always been political tension. Korean wars, Vietnam wars, Middle Eastern wars. I mean, this is not new. Please don't think that poor management of countries is something that's new to us today. It's not. It just hasn't been as prevalent or as exposed until most recent. But it's been there. So I'm going to not completely read that last little bit. But the short answer is right now, our markets are acting ridiculously, I never can spell that. It will never be resilient. And it doesn't make sense. It truly does not make sense. It's taking fundamentals and throwing them out the window. Are we overprotected? We're not. We're not overprotected. Our protection in the last year has made up huge amounts of money. Pretty interesting. We are still down, but in our particular group, 16,589, it really should be to about 17,200. But our cash was less than $340,000. And in the last year, we've changed that to $3.8 million. So we've been making up significant amounts of money on the way down. We haven't deployed it all back to work. We are not certain of where we're going. No, we did not miss the last 9% on the way up or 10%. We've did little purchases here or there, but we are cash heavy when we were, 4%-ish almost roughly in cash. Now we're closer to 25%, almost. We're not quite 25%. So is what we're doing working? It is. This is a longer cycle. In all honesty, this is a longer cycle than our 2020 stealth 20% drop. And if you want to see that one, just Google search. Actually, I guess Google/YouTube, right? Hurley Investments results 2020. And you'll be able to see what we're talking about and why we're saying what we're saying. So, that's why you're down 63%. You're down 63%. You still have a couple $100,000 left because you were over leveraged in bullish trading option strategies where adjustments were slow because it was uncertain, or you were in stock replacement strategies that you had over leveraged your portfolio that's put you in this position. I would always suggest you have really 80% of your portfolio in stocks that could be protected with options, 10 to 15% speculative, and that leaves 10 to 5% cash. And your portfolios are always moving, right? They're moving in what regards to happening in the market, where you have opportunities. But really, there are some positions that look really good where Keith and I need to go through and maybe purchase another 100 shares of Disney for those people that are in Disney. We're going to nibble. We're not going to just throw it all in all at once. That's not what we do. But that is why your portfolio is down 63% year to date. You were just over leveraged to the all-in side. Okay, earnings dates. Baidu has changed to maybe the end of August. Disney is this Wednesday. Dollar General's on the 25th. Costco's on the 22nd of September. We're basically done with our earnings picture for the near future. Last week we had a phenomenal jobs number. Usually you don't have a big uptick in jobs before the August kids are going back to school type of I don't know, expectations. It was wild to expect 250 non-farm payroll jobs and to get 586. Private jobs to be what, 200 and to get 480 something. It was just outrageous. So the market took it as, hey, job market's good to go. Feds are going to keep raising like there's no tomorrow. Jeez. I understand it. We don't know where the Fed's going to go. We don't know if Powell knows what he is doing. Historically, the last 20 years, since Volcker or Greenspan, which is even later, the Fed has been behind the 8 ball consistently. And they are behind the 8 ball again. So, so the short answer is, our Fed will probably put us into a deeper recession going into next year. And we might start to pull out of it in that sell in May, go away time period as our recession is more done from supply and demand. Let me put that back. Our inflation is more from supply and demand than it is from runaway inflation with price hikes. We are in a supply and demand inflation for oil, for chips. We're not in it because of runaway global inflation. Obviously, tons of stimulus does not help, but it was not the cause. It did exacerbate our inflation bubble that we're in right now. So shallow inflation, most likely. I didn't get the most recent Y chart one, so I will see if I can't get that really quickly. Grab that and put that in here. So Kevin, how do you trade realizing that the Fed doesn't know what they're doing? Again, we've been that way for about 20 years. Volcker and Greenspan were the last two Fed chairs that seem to have been ahead of our inflation, and the policies that they put in place seem to be ahead of what we were running into. So you trade like you always do. You look for bigger runs here or there. All right, on the Dow Jones Industrial Average, just took this. That volume cannot be correct, but we are in no man's land. Right now, we were in between the 200-day and the 50. You can't split it any better. Can't seem to go above. It would not surprise me if we went sideways for a couple months. Being sideways for a couple months is actually beneficial. It will put a base in our market, and it will get us through the typical September, October, which are 2 of the 3 worst months that we deal with in our stock market. It would be nice to see oil keep coming down in price, though. Still technically bullish. S&P resembles the Dow. We are stuck in no man's land between the 200 and the 50-day. I did think we would go and we would retest the 36, if not 32. Now I would change that, and we're probably going to retest the 50-day simple moving average. One test, broke above it. It just seems in threes, triple bottoms, push markets higher. So maybe we'll drift down another 5% from here and retest the 50-day. That would be a September, October expectation. And then the neat thing is the United States usually runs into a Christmas rally because Americans are foolish and gluttonous. We spend for Christmas like there's no tomorrow. Apparently, we did not write that into the Constitution correctly. That is our God-given right to spend for Christmas because we enjoy new gifts. All right, here. Let me grab the NASDAQ. Exactly the same thing. Chips will move the NASDAQ. It'll be news. If we run on more chips or less companies like NVIDIA today that pre-announced they are not going to meet their numbers, nor will meet their future expectations because of chips, our market was up 0.9%. And NVIDIA pre-announced, it dragged the whole market down almost 0.6%. And I see we recovered and we're relatively flat today. I still think we'll be up 2% for August. Earnings, we have gold, Groupon, Dominion. Dominion today beat top and bottom, but Dominion is down. So a lot of people say, Kevin, how come they beat top and bottom if they're down? Their conference calls, their projections or expectations for the full year or next quarter were not really good. Dominion just, they beat a couple cents on the top line, a couple cents on the bottom line. And those poor buggers they're down 1.43% today, down another 0.1% after hours. So chances are they are just going to keep going down to their near support level, which I think is around $76 to $74. Tuesday, Akamai and Wynn Resorts, kind of interesting to watch those two. Ralph Lauren. Wednesday, Jack in the Box, Wendy's, and Disney. After hours, Disney will be paying attention to it. Cardinal Healthcare, DDS, DuPont, and Six Flags Magic Mountain. This is the first week that we'll start the retail numbers. Next week and the week after, we'll get more Targets, Ross stores, those kind of things. Economic reports, pretty light. CPI numbers on Wednesday, which will be inflationary. It probably won't be good, but we do have a price in oil coming down. Thursday, PPI inflationary numbers will probably not be good, but we do have we do, and yes, Jim, I will do that. We could see the start of those numbers coming down, which would be helpful due to energy. All right. Currently, I have some protection on core holdings, making decisions on earnings, and we are letting some things run after earnings, which is nice to see. Interesting article about danger ahead. The U.S. economy has yet to face its biggest recession challenge. And of course, that is the Fed tightening into a recession. Bank of England launches the biggest interest rate hike in 24 years, predicts a lengthy recession, which is, again, the same thing that we're seeing here in the United States. What questions do you guys have that I can answer for you? Any questions you guys have that I can answer? Or that we could go over for you guys while you're here. So Kevin, what will you do if we head sideways? Great question. So if we start to head sideways, I will add the short call at higher strike prices to create a short-term revenue stream. All it says is, hey, we agree to sell Apple up at 180. And we might get a couple bucks for it. We wouldn't do anything on Boeing or Baidu because it has too much upside opportunity. But again, if I can go through some of these stocks, let me go through them one more time. So we wouldn't cap Apple. We wouldn't necessarily cap Boeing or Baidu. Bank of America, though, can't seem to get above 36. 10% higher, we'd put a cap on that with that short call, and we would get a credit that we would hopefully have expire worthless. Disney, I'll know more about that one. Ford, we could put a cap on Ford at 1750, get some credit in for there. We'll probably not go above 1750. Google L, we would not cap. JP Morgan, we would not cap. It has too much upside potential. Coke, we could cap at 65. Lockheed Martin, we would not cap yet. Meta, we would not cap yet because it has too much upside potential. Micron, we would not cap yet because it has too much upside potential. Starbucks, you could cap at 90. Square, you could cap at 90. Target, you could cap at 180. Under Armour, you wouldn't cap because it has too much upside potential. And you wouldn't cap Visa, but you could cap Verizon at like $50 there. So there's some stocks that have a lot of upside opportunity. For the ones that do not, that haven't been hit as bad or that have recovered already, those stocks are probably not going to make new highs before the next earnings season. So we cap their upside by selling a short call, which is the obligation to sell a stock at a certain price for a certain period of time. And we take a credit, a 2 or 3% credit in, that we try to have that stock not move that high through September, October. We get to keep that credit. It's like you're getting paid to wait for your stocks to move. Again, I made the comment this would be more of an options or those that had stock market education review. If you'd like to go over that with me, you can always just shoot me an email and we'll set a time so I can go over what we would do with you to have a better understanding. But that would be the general idea. Great question there, Lance. It's a stagnant type strategy that you use with stock ownership that pays you up front 2 to 2.5% of the value of your stock to wait to see if it can go higher. And there are some of those stocks that fit in that category. Unfortunately, I mean, Apple's kind of where it's been. It's been up to 81. Bank of America, Boeing can get back up to 400. Bank of America get back up to 55. Baidu back up to 350. So those are stocks that have this huge springing upside opportunity. You don't cap. You don't take that risk. You just run and let things continue to hopefully head higher. You don't cap Disney at 109. It's gone down post-COVID. It's making great movies, making big money again. It's dirt cheap. You don't cap Disney. Ford, you could cap at 1750, a long-term resistance level. Google L, you don't cap because it's split. JP Morgan, you don't cap because it should be back up to 180. That's just too much upside. Coke can't seem to get above 65. You cap Coke. Lockheed Martin can get back up to 480. You don't cap it. Meta can get back up to like 280. You don't cap it. Micron get up to 100. You don't cap that stock. Newmont Mine Corp can get up to about 60. but gold and silver out of favor. You could possibly cap that one. I would recommend against it. You could cap all the cruise lines. Starbucks you can cap because it just can't get above 88, so you cap it at 90. Square, you probably don't cap, too much upside potential. Under Armour can at least get back up to 22 this year. You don't cap it when it's trading at $9.82. Visa sitting at 213, can be at 250. You don't cap Visa. Verizon will have a hard time getting back above 50. So you do cap Verizon at 50 to get a little bit of money coming into your account. It's just that thinking or mentality there, Lance, on how can we create revenue as the stock market's moving sideways. All right, I don't see any other questions coming in. Anything else from anybody? All right, then let's call it a night. I appreciate you guys being here. Most likely, Key will be taking next Monday evening's class. Jim, I've got you written down for Wednesday morning. I will give you a call Wednesday morning. And guys, appreciate you being here. Hopefully this is helpful. Hopefully this is a good opportunity for you to see what we are looking at and what's happening. Again, if you do have any other questions, it may be because you are not from the education side of things, and I was speaking more to those on the education side, don't hesitate to just zip me an email. That's what I'm here for, is to make sure I get all of your questions answered. Guys, take care. Have a good evening, and I look forward to seeing you here again in 2 weeks. Bye-bye.